2011, the developed markets still struggling, frankly. You have an environment where there are continual questions surrounding sovereign risk, particularly in Europe, with Spain, Portugal, Greece. What is ultimately going to happen with the debt that has been created there? What is ultimately going to happen to the euro? Our view is essentially that that struggles through and that there is no crisis ultimately in the European markets, and the euro survives, although it continues to be a risk. And I think what you're going to see is a continual volatile market in Europe because people are very anxious about what's going on, and it always seems to be risk on, risk off in the equity markets. So the volatility will continue in Europe, in the European markets. There's a big question. I think most of you know that the UK government has gone for an austerity program where the US has not. The US continues to pump money into the system and is certainly not cutting its budget deficit by any significant amount. We'll see where the two philosophies come out at the end of the day. But I do think that the U.S. Impact on the rest of the world will continue to, as I say, increase this volatility, because you're going to have a situation where until the developed countries repair their banking systems, essentially the European markets and the U.S., until those banking systems get repaired, recapitalized, and can begin lending in any substantial way back to business, I think you're going to have an environment that's going to be very low growth. You're just not going to be able to sustain a lot of growth in these countries until the banking systems are repaired. And frankly, I think that's going to take a couple years. So our view globally from a macro perspective is that we continue to have relatively low growth in Europe and the US versus the rest of the international environment. In emerging markets, what we've seen is a cyclical rebound. As I say, there was not a financial crisis in emerging markets. The banking systems are reasonably well capitalized. They went through a crisis back in the late 80s, early 2000s, so they cleaned up their problems and they did not have a mortgage problem like you saw in the developed markets. But the issue is increasing, and the risk is increasing now as we've gotten inflation back into emerging markets, because a lot of the fund flows, liquidity that has been generated in developed markets has actually landed in emerging markets. So you've got increasing inflation and increasing government responses to that. So essentially you have a rate increase environment in most of these emerging markets because frankly the economic growth is too strong. We worry about economic growth in the US and Europe being too low, but it is too strong in many places, including China, India, Brazil, where these economies have overheated. Current account deficits are starting to come back and increase in some of these countries. So the governments are responding to that by raising interest rates, as you would expect. The other thing that is compounding the problem is that the currencies have appreciated against the dollar, which then make these governments want to control capital flows in and out of the country. So we're looking at an environment in a lot of emerging markets where you've got an increasing interest rate environment coupled with increasing capital controls by the governments, which becomes problematic. So emerging markets, I think over the next several years, certainly is going to be where the growth is. You know, I think everyone recognizes that, or the consensus view, which I hold, frankly, is that slow growth, relatively slow growth in developed markets, faster growth in emerging markets, but there is a risk attendant to that fast growth, and that comes with currencies and higher interest rates and government intervention. Fund flows have been tremendous. I also manage our emerging market fund, which we're getting ready to close. All of the fund flows essentially that we've seen have been into our small mid-cap product and our emerging market product, and that comes from institutional investors in the US, where money is moving out of the US, moving into emerging markets, and that continues into this year. If you look at the fund flows into ETFs and commodity funds, all of that liquidity is being pushed into emerging markets essentially.